Hey guys, welcome back to the channel. In today's video, we'll be talking about Stan Weinstein stage analysis. What is stage analysis? According to Stan Weinstein, there are 4 stages of a market cycle. And knowing these 4 stages of a market cycle will allow us to identify the trends of the market so that we can trade with the trend and increase our probability of success in the stock market. Stan Weinstein believed that we should pay attention to the charts rather than news headlines. There are a few things to pay attention to our price charts, but one of the most important things to pay attention to is the trends of the market. And using Stan Weinstein's stage analysis, we will be better able to determine the trends of the market and identify which stage of the market cycle we are in. This is a graphical look of what Stan Weinstein's stage analysis looks like. As mentioned, there are 4 stages in a market cycle. There is stage 1 where prices basically trade in a range, and then stage 2 where prices make most of its advance in, and stage 3 where prices usually tops out, and stage 4 where prices decline. We'll take a greater look at the 4 stages in Stan Weinstein's stage analysis. We'll start off with stage 1. Stage 1 is also known as the basing area. It is an area on our price charts where prices form its base before advancing in stage 2. In other words, you can say that in stage 1, prices are forming the foundation for their subsequent advance. After moving downwards for a while in stage 4, prices will eventually move sideways. And as prices start to move sideways, its 30-week moving average will start to lose its downward slope and start to flatten out. These are the 2 characteristics to pay attention to in a stage 1 market cycle. To identify a stage 1 on our price chart, we want to see prices moving sideways after decline. And after prices have been moving sideways for a while, we also want to see the 30-week moving average move from its downward slope in stage 4 to a more gradual and flattened slope in stage 1. But we don't want to buy just yet in stage 1. Even though prices have stopped declining substantially, we don't want to buy in stage 1 just yet. This is because even if you catch the exact low in the base area of stage 1, your money could be tied up for a long time with little movements. Prices can move sideways for a couple of months or even a couple of years. And even as investors in the stock market, we do not want to see our money tied up in a stock that has little movements over time. Because even if we are not losing money when the stock is tied up in stage 1, we are still incurring opportunity cost. Opportunity cost means that our capital could be better used in investing that are already in their stage 2 advance rather than moving sideways and basing in stage 1. What follows next is stage 2, and stage 2 is also called the advancing phase. The start of stage 2 happens when prices break out from the base which is formed in stage 1. An important distinction to make here is that not all breakouts in stage 1 will lead to a start of stage 2. However, every stage 2 starts from a breakout from stage 1. Often, at the breakout point where stage 2 begins, the reported fundamentals of the company is likely to be negative. But remember, what Stan Weinstein's advice was that we should be paying attention to the charts and not to the news headlines. So even if the reported fundamentals of the company is weak at that point in time, if the stock breaks out in strong volume and manage to hold above the resistance, we should be paying attention to the charts and not to the headlines. For stage 2 in the market cycle, we want to see prices breaking above the resistance and the 30-week moving average. In stage 1, the moving average will start to flatten out. And as prices move from stage 1 to stage 2, we want to see the 30-week moving average start to slope out. The ideal time and optimal point to enter or buy position in a stock is when the stock breaks out from stage 1 and move into stage 2. At this point, the risk to reward is good. And that is why we want to enter our position just as the stock breaks out from its stage 1 phase and begins its stage 2 phase. This is a graphical illustration of what stage 1 and stage 2 of the market cycle looks like. Over at this basing area, prices are in stage 1 because we see prices moving sideways for a while, and we also see the 30-week moving average start to flatten out. And over here, as prices broke above the resistance and broke above the basing area, we want to look to enter our position in the stock when prices break out of stage 1 and move into stage 2. Point A points to the area where prices broke out and where we want to look to enter our position in the stock. And you can see that after prices broke above the basing area and the resistance, prices begin to start its stage 2 phase. And the stage 2 phase is where prices start to move upwards and advance. Following the breakout from the stage 1 base area, there is usually an initial rally followed by at least one pullback. So if we take a look back at the graphical illustration, over here we had the breakout and then we had a pullback. And as long as prices remain above the resistance and above the basing area, it is nothing to worry about. An important point to take note in stage 2 is that even though stage 2 is an advancing phase, prices do not go up in a straight line. There will definitely be pullbacks. So as long as the swings and pullbacks take place above the rising 30-week moving average, those swings and pullbacks are normal reactions. And in stage 2, we'll see prices forming higher lows and higher highs. And when prices form these higher lows and higher highs, that is how we determine that the trend of the stock is on an uptrend and in stage 2 of the market cycle. As the stock price continues to advance and move into the later stages of stage 2, the stock will eventually start to set closer to the 30-week moving average. The gradient of the 30-week moving average will also start to lower down. Even though the slope of the moving average will start to slow down, the slope of the 30-week moving average is still sloping up. And when the stock advances and moves into the later stages of stage 2, we don't want to buy the stock because at this stage, the risk to reward ratio is no longer as good as before, such as when prices first broke out above the basing area and resistance. So if we miss out on that initial entry, we do not want to chase the stock. The only time we want to buy the stock when it is already in the later stages of stage 2 is if the stock consolidates and forms another new base. And this leads us to stage 3. In stage 3, this is an area where prices usually tops out. At stage 3, the stage 2 advance experienced by the stock loses momentum and starts to move sideways. The 30-week moving average starts to lose its upward slope and also start to flatten out. And in this stage, volume is usually heavy and price movements are sharp and choppy. This is because late buyers are excited about the improving fundamentals and will want to look to buy the stock. At the same time, this will be met with aggressive selling by people who are already taking profits on the stock. These sellers are usually the ones who have bought early on the stock. So in the stage 3 area, the stock is transferred from those who have bought early to the people who are late in the game. And as the stock is transferred from one hand to another, the stock moves sideways for a while. When prices move sideways for a while after a stage 2 advance, it usually signals the start of stage 3. However, this is not always the case. Sometimes as the stock moves up in the stage 2 phase, the stock might consolidate for a while to digest its advance. And as a result, the stock also moves sideways for a while. And once the stock managed to digest its move before, it will continue its upward movement. So it will look something like this. This was the stage 2 advance. And over here, prices move sideways for a while to digest the move before it continue to break out and continue its advance. So how do you differentiate a short consolidation before continuing its stage 2 advance versus a topping pattern in stage 3? The difference is where we see prices breaking out from. If prices consolidate for a while and break to the upside, this likely means that the stage 2 advance is continuing. However, if prices consolidate and break below the basing area, then this likely means that the consolidation is the topping pattern in stage 3. The last stage in Stan Weinstein's stage analysis is stage 4. It is also known as the declining stage. Prices break below the bottom of the range formed in stage 3. On top of breaking below the range formed in stage 3, prices also break below the 30-week moving average, and the moving average also starts to slope downwards. And as prices decline in stage 4, each decline drops to a new low, while each rally falls short of the previous peak. In other words, in stage 4, we see prices forming lower highs and lower lows. And in stage 4, never ever buy or hold a stock during this stage. This is very important. No matter how good the fundamentals of a company is during that period of time, as long as the stock is in a stage 4 decline, if you own any position in that stock, make sure you get out as fast as possible. And if you do not have any positions in that stock at that period of time, make sure you do not buy the stock in a stage 4 decline, no matter how good the fundamentals of a company is. Because at this stage, what is cheap can get cheaper. Now that we have taken a look at the individual stages, let's go back to the graph to have an overview of Stan Weinstein's stage analysis and the 4 stages in the market cycle. Stage 1 is where prices consolidates and form the base area. And during this time, as prices move sideways, the 30-week moving average also start to flatten out. So in stage 1, we don't want to buy just yet, because prices can move sideways for an extended period of time. And we do not know when prices will break out above the basing area. And as prices start to break out from the basing area in stage 1, and break above the resistance, this begins the stage 2 phase. And during the stage 2 phase, prices are above the 30-week moving average, and the 30-week moving average also starts to slope up. In this advancing phase, prices make higher lows and higher highs. And in this stage, this is where we want to buy and hold tight onto our stock. The ideal time and optimal position to enter our stock is when prices first break out of the stage 1 basing area. And once we enter our position in the stock, we want to hold tight to our stock. Because even though stage 2 is an advancing phase, prices will not move up in a straight line. Instead, prices will move up in a wave-like motion, and there will definitely be swings and pullbacks in the advance. As prices continues to advance in stage 2, prices will start to move closer to the 30-week moving average, and the gradient of the 30-week moving average also will start to be lower. And this leads to the setup of stage 3, which is also known as the topping area. At this stage, prices start to move sideways, and the 30-week moving average start to flatten out. During this stage, in stage 3, volume tends to be high, as aggressive selling is met by excited buying. After topping in stage 3, prices will break below the stage 3 range. And when prices break below the range, this indicates the start of stage 4. At this stage, prices fall below the 30-week moving average, and the moving average also start to slope downwards. This stage, stage 4, is also known as the declining stage. Prices start to decline and form lower highs and lower lows. And it is also in stage 4 where prices are in a downtrend. After prices have declined for a while, it will start to form a new base. And this is where stage 1 begins again. And the market cycle repeats itself again. These are the 4 stages in a market cycle and Stan Weinstein's stage analysis. If you have learned something from this video, smash the like button because it will really help the channel grow and allow me to produce more content such as this. And if you haven't already subscribed to this channel, make sure you subscribe to this channel because each week I release new videos about investing, trading and the stock market. I'll see you in those other videos. To your financial success.